Hi, my name's Jim Femia. I'm a senior financial advisor with Apella Capital. If you have a son or daughter who is either in or about to enter high school, please stick around for the next 15 minutes to learn how to avoid the three most common college planning mistakes. So I've been in the financial services industry since 1991, and I've spent the majority of my career working with individuals providing independent, fee-only investment advisory and retirement planning services. Back about 10 years ago, I incorporated college planning into my practice. And the more college planning I do, the more I realize that college planning and retirement planning are really joined at the hip, because the decisions you make on how you put your kids through college could have a huge impact on your own retirement. And ask yourself this question: how old am I going to be when my youngest graduates from college? I know for me, I'm going to be almost 60 years old by the time my son graduates from college. Does not leave me a whole lot of time to prepare for retirement. So the last thing you want to do at this point in your life is to make a major financial mistake where you end up jeopardizing your own retirement. That's why I'm in this market, to help parents through that very situation. Now, in my experience, there's really only two ways to pay for college. You can use your money, or you can use other people's money. So if we look at your money, right, the first place will be to come from current cash flow. So you'll take a look at your monthly budget. How much do we have coming into the household every month versus how much is going out? Hopefully there's a surplus there, and you can earmark some of that discretionary income to pay for college while your son or daughter is in college. Secondly would be borrowing. Most families are faced with some sort of borrowing program, whether it's borrowing from the federal government, a private resource, borrowing from home equity, whatever it may be. The thing is, with this borrowing program, you as the parents are responsible for paying back this loan, so it's your responsibility. The third source of your money would be savings. Hopefully you've had the foresight and have been saving some money over the years, whether it's in a 529 college savings plan, an educational savings account, or even a brokerage account. But that's money that you've been saving up until this point that you're going to use now to pay for college. Now, the more preferable way to pay for college is by using other people's money. Hopefully you'll be getting some gifts from relatives. That's a possibility. Children's resources. So again, your son or daughter, maybe they have earned income, maybe they've accumulated assets, or you could talk about the students taking on some student debt. The difference here is the student is responsible for paying back the loan, not you as the parent. There's some educational tax strategies that are also available. But then finally, the largest source of other people's money comes from the financial aid system. And here's the number one mistake that parents make, is they never take the time to understand how the financial aid system works. It can be overwhelming. There's a lot of information out there, but the reality is, if you have understand a couple of basic concepts, you could save yourself thousands of dollars over a college career. So let me give you a quick review. There are really two types of financial aid. There's merit-based financial aid, which is all based on the qualities of the student. And then there is need-based financial aid, which is all based on the finances of the family. So let's start talking about merit. First off, merit is free money. It's gift money. Sometimes they'll call it a grant. Sometimes they'll call it a scholarship. Sometimes they'll call it the presidential award. Call it what you want. It's free money that doesn't have to be paid back. Now, merit aid is awarded based on the strength of the student resume. And student resume is simply a term that I use, and it refers to your son or daughter's GPA, their standardized test scores, their extracurricular activities, their essays. All these different things go into building a student resume. And the stronger that resume, the more marketable the student is. And schools are going to compete for kids with strong resumes by offering merit money, free money that doesn't have to be paid back. Now, there's two important things to know about merit. First off, everyone is eligible for merit aid. You could be making $1 million a year of income. You could have $10 million in the bank. Does not matter. Every student is eligible for merit aid. Second important thing to know about merit is not all colleges offer merit-based financial aid. So the last thing you want to have happen is have your student apply to 6, 8, 10 schools, get into some of those schools, and then find out after the fact the school doesn't even offer merit-based financial aid. Second type of financial aid is called need-based financial aid. And again, need-based aid is based on the finances of the family. So here's the formula they use to determine need, which is COA, which stands for the cost of attendance, minus EFC, which stands for the expected family contribution, and the difference is need. So in the fall of your student's senior year, you'll be completing a couple of financial aid documents, at least one, maybe two, You'll definitely be completing the FAFSA, the free application for federal student aid, and possibly you'll be completing the CSS profile as well. So on these forms, you'll be reporting parent income, parent assets, student income, student assets, some demographics of the family, and the Department of Education and the colleges themselves will do a calculation, and it spits out a number called your expected family contribution, your EFC. And this is the minimum amount that they expect you to pay for one student for 1 year of school. It's your deductible. So again, you take the cost of the school minus your expected family contribution will tell you if you qualify for any need-based financial aid. So let me give you an example. Let's say you apply to a school that costs $70,000 a year. That's the cost of attendance. And that will typically include tuition, room, board, books, living expenses. The school will tell you what their cost of attendance is. Again, you as a family file your financial aid forms, and let's say hypothetically your family's expected family contribution is $40,000 a year. So you just plug it into the formula. 70 minus 40 means you're eligible for $30,000 worth of need-based financial aid. Now, in a perfect world, the school is going to come back to you with a $30,000 financial aid package. So you'll be responsible for your EFC, your 40, and then the school will give you a financial aid package worth of 30. But one thing to be aware of, not all schools, as a matter of fact, most schools do not meet 100% of need. So as you'll see in this sample, we have some schools that hypothetically will only meet 60% of need. So if you have a $30,000 need, you're likely to receive a financial aid package worth approximately $18,000, which means there's a $12,000 gap, which then gets added to your expected family contribution. Now you're paying $52,000 instead of $40,000. So in summary, there's two things you need to know. First off, you need to know what is my expected family contribution and am I going to be eligible for any need-based aid? But then secondly, what are the chances of my son or daughter being offered merit-based aid based on their accomplishments while in high school? The second largest mistake that we see in the college planning process is parents wait far too long to begin this. Now, I run a series of seminars, college planning seminars in the New England area every fall. And the first question that I always ask of my audience is, how many of you have parents of freshmen? And typically I will get no hands. How many of you are parents of sophomores? I may get one hand. How many of you are parents of juniors? I may get two hands. And how many of you are parents of seniors? And I will get 20 hands. Let me tell you, if you're waiting until the senior year of high school to start this process, chances are you're too late. Now, there may be some small modifications you can make to save yourself a bit of money, but the real planning opportunity comes much earlier than that. And let me explain why. The Obama administration made a significant change to the FAFSA, the free application for federal student aid. And it's referred to now as prior year. So a student's college financial aid eligibility will be now based off of income from 2 years prior to when the student enrolls in college, not the 1 year prior, the way the rule had been previously. So again, as I stand here today, it's September of 2018. So if you happen to have a rising senior who will graduate in 2019, they will be using your 2017 tax return to determine your financial aid eligibility. Again, we're in the middle of 2018. There's not much you can do about your 2017 tax return. That's gone. If you have a rising junior who will be graduating in 2020, they will be looking at your 2018 tax return. Now again, we're halfway through 2018, so the longer you wait, the quicker you lose that planning opportunity. The real optimal point or point in time to take a fresh look at this would be your sophomore year. We are graduating in 2021 because they'll be using your 2019 tax return. So they'll be looking at next year's tax return. So wouldn't it make sense for you to understand what you need to do to position yourself before you move into 2019, before you file for financial aid? And even better would be freshman year, 2022. They'll be looking at your 2020 tax return to determine eligibility. And then finally, the third most common college planning mistake that we see is that parents don't really understand the impact on their own retirement, putting their kids through college, what sort of impact that is going to have on their retirement plan. Now, I'm approached by parents all the time who have kids that are maybe into their junior or senior year of college, and they've sort of gotten themselves into a mess and they're trying to figure out, how do I work my way out of this, right? And I've seen situations such as families that have depleted all their savings, right? They've borrowed from their retirement accounts. They've depleted their 401k plans. They've stopped making 401k contributions, thus giving up the company match that's available to them. I've seen a lot of families that get in a situation where they end up borrowing way too much. You know, freshman and sophomore year, those monthly payments can be manageable, but once you get into junior and senior year, they become very prohibitive. And then finally, I've even had a couple of folks that have maxed out their home equity, and a couple of situations where families have had to downsize, sell their home, and use the equity or the proceeds to help pay off the college loans. So obviously, we want to avoid that. So let me give you an example on why this can be so dangerous. One of the most popular loan programs for parents is a federal program called the Federal Plus Loan. And in this example, I'm assuming that this family is going to spend $30,000 out of pocket to put their student through college. So let's say hypothetically the cost of the college is $60,000. The college provides you with a financial aid package worth $30,000, which means you have to come up with $30,000. So one of your options is you can go directly to the Federal Plus Loan and you can borrow $30,000. Now the current rate on this loan is 7.6%. That's based on this current year, 2018-2019. And again, in this example, I'm assuming you're borrowing $30,000 for 4 years, and you're going to be on the immediate repayment program, which means you're going to start paying back principal and interest right away freshman year. So in summary, you're going to borrow $120,000 to put your son or daughter through college, and with interest, it's going to end up costing you almost $172,000 to borrow $120,000. Now, I want to give you a sense of what your monthly payments would look like if you were involved in a program like this. So first year comes, you can borrow your $30,000. Your monthly payments are going to be $358 a month, approximately. Now you move into sophomore year and you need to borrow another $30,000. Now your monthly payments have doubled. You've gone up to $716 a month. Now we're in junior year. You have to borrow another $30,000. Now your monthly payments are $1,073. And now finally, you have to borrow your final $30,000, okay? You are now up to $1,431 per month, or over $17,000 a year, going back to the Federal Plus loan provider. Okay, you think that's going to have an impact on your retirement? My guess would be that this is going to put you in a position where you're no longer able to contribute to your 401k plans, and you're not going to be able to save for a safe and secure retirement. So let me conclude with a suggestion. You need to be proactive. This is not something you want to figure out as you go. You do not want to wing it. So for those of you that have a relationship with a trusted advisor, whether it's a CPA, a CFP, a financial advisor, whomever it is, I suggest you reach out to them immediately. And you want to set up a meeting, and you need to understand, what is my expected family contribution today? Before I file financial aid paperwork, what is that EFC? And just as importantly, is there anything I can do to lower it? Now, if your advisor is unable to help you, you need to make an important decision. You need to figure out this on your own, or you need to find someone that can help you. And fortunately, Apella is here to help you through that process. The other thing I'm going to suggest you do is take a step back and do a true evaluation of your son or daughter, and evaluate the chances or likelihood of them being offered merit-based financial aid. And just as important, which schools are likely to offer them merit-based aid to attract them to their school. Fortunately, you're seeing this early enough where you can start this process early. Like I said, the earlier the better, but the deadline for most parents should be freshman and sophomore year. Junior year, there's a little bit of room, but senior year, again, most of the planning opportunities are gone at that point. You also want to evaluate funding strategies. Is there anything we can do to reduce the cost? And how are we going to pay for this? Are we using income? Are we using assets? Are we going to borrow money? And if we do have to borrow, where's the best place to borrow it from? And then finally, how is college planning going to fit into our overall retirement plan? Now, as an independent fee-only financial planning firm, we work with our clients to help customize a holistic plan to help you figure out, how do we get our kids through college without jeopardizing our own retirement? Thank you very much. For those of you that are interested in taking advantage of our no-obligation consultation, please reach out to the information below. Thank you.